Hello everyone, it's Greenman here. I'm here today making a video on options trading. A lot of members in the green room have requested this video so they can possibly get started on options or get some guidance on how I look at options. So I wanted to make this video to clear that up for a couple people. And I'm going to start off by going over the basics, and then I'm going to get into my strategy with options and how I apply them to my trading. Um, to me, they've been very useful over the past couple months because the market really hasn't been too bullish. It hasn't been worth it to hold stocks overnight, and because of that, I'd rather sleep well at night, knowing that I don't have any open positions and just trade the next day uh, while the market is open and try to make my money that way. So I'm going to get into my strategy a little later. First, I'm going to explain for the beginners what exactly an options contract is in very simple terms, not technical. It's basically betting on what you think the price will be at by a certain date. And essentially, if the price of the stock is not over your strike price of the contract by that date, it'll be worthless basically at zero. So the reason these contracts have value is because if the price of the stock is over your strike price, that means that on that date you or whoever you sell the contract to, whoever has that contract by the expiry date, can exercise the stock at the price of the strike. So let's say the SPY is at 450 and you have a 440 call. That means you can exercise the contract at 440 and instantly sell it the next day at 450 if you please. So um, basically, that's the value of an options contract. If you are in the money by the expiry date, there's a specific value to that, which is uh, like basically a calculated value based on several factors, what the price is at, how much it can be exercised for, what type of profit you can get on that. So basically, when your options, let's say you have one contract, that contract will be exercised into 100 shares. So let's say you have your strike at 440, you'll be able to you'll be able to convert that one call into 100 shares at 440, while the price of SPY is at 450. So instantly you have a big profit, and basically that's where the value of the contract is adjusted. So based on how much you could sell it for in the profit, that'll change the value of the actual contract. So that's basically the math of it and how the price is affected. Um, there's a couple websites I'm going to go through later. I'm going to explain a bit, show a couple contracts here on Webull, and there's also an options profit calculator. Um, Basically, what the contract could go to if a price is at a certain level. There's a good website for that. Um, so I'm going to start off by saying too that there's 1,000 ways to trade options. Um, some people use options as a hedge. Basically, they go long on the stock and they use options, put options as a hedge in case they see a violent pullback, and they could use it that way. You could use it by swing trading options. I know some people who do that, but personally, I prefer to swing trade common shares and day trade options, um, due to the fact that time decay plays a big role in the value of the contract. So um, unless I'm expecting a big and quick move that could make an options contract surge like extremely, I'd rather trade common shares. So basically, my approach to options is scalp trading strictly, and I'm really trying to just focus on that. It's been working for me, so that's how I prefer to trade it. And like I said, for swing trading, I prefer to trade common shares, which is it's a different game than options. Options is pretty complex and very fast paced. So very quickly, to give a bit more detail on the options, um, here are the options contracts for today on SPY. The current closing price was 440, 441. Expiring tomorrow, these 432 calls are up 53%. The 441 were only up 12%, even though SPY did a $5 move. So because it's not in the money yet, it still hasn't gone up extremely because there's still no value of it unless it really closes the week way above 441. So the 432, which is really in the money, is up 53% because it's basically whoever um, exercises this contract will get the shares at 432 and can instantly sell at 441, which is a big profit. So that's why the value of these is really increasing, and it makes total sense. Um, the puts are down big time today after a big move. Um, Basically, just giving you a quick overview on the spread right now. Um, there are certain options that here's Apple as well. There are certain options that have very close spreads. So let's say SPY is always a close spread. Uh, let's say for the 440, the bid is at 157 and the ask is at 161, which is really good. There's a lot of liquidity, a lot of volume as well. And there's some other options in some smaller options trading stocks that have huge spreads where you could have like a bid at $3 and an ask at like $6. So you really gotta, if especially in day trading, you really gotta pick and choose which options chains you want to trade. Some stocks are like you could predict the move on that stock 100%, but the options chain sucks, so you don't want to be trading those. You want to be trading stuff with a lot of liquidity and flexibility, basically. Um, so that being said, I'm gonna give you a quick tip on this options calculator website. So let's say you're buying a call, stock symbol is SPY. I'm gonna buy the contract. And here you're choosing which contract you're going for. So let's say the 440. So the price of that contract closed at 159, 160. So like I said, it's once it's exercised, it's times 100 as well as the price of the contract. It'll show 159, but times 100, it costs you 159 to buy that one contract. $1.59 to $159 basically. So once you calculate it, it'll give you a spread on how you can profit or lose on this trade. So it was a 440 call, so meaning your strike price is 440. So basically, it says your break even is only at 441.60. So for basically you got to be a bit more in the money than your actual strike price because it's basically how much that the exercise price can be sold for. So that's basically how the value works, and also the time affects this as well. So basically, your break-even price it's estimating is around 441.60, even though your strike price is 440. So it's assuming you'll be in the profit around that price, and let's say by tomorrow it hits 447.50. It's predicting that you'll be up 372%, up $591 from that $159 investment. Let's say it goes to 443, it's expecting an 88% gain. And if it's anywhere under the 440, you're down 100%. 440 and under, you're down 100%. So if it doesn't close above 440, you're 100%, like a 100% down for 100%. So it's going to basically go to zero the contract. So this is why options is extremely risky and not for everyone. Um, Anything can happen. If your strike price is not achieved by the expiry date, it will be at zero. It's just the simple reality of it. Um, so that's basically the rundown on options and quick little breakdown for those who are new to it. Now I'm going to be going over my strategy and how I use them. So like I said, for swing trading, I prefer to trade common shares, but for options, I've started to really like day trading key levels and basically profiting on in and out trades, very quick scalps on very high risk option contracts. Um, so just to go back into it, these are very volatile options because they expire Friday, so tomorrow. So you can see some huge moves on those. That's why the puts are down in huge amounts, calls are up a lot, big amounts. But the further you go out in dates, the less volatile they are. So here you can see the gains really aren't as big as the other ones, the ones of tomorrow, but they reflect based on how far out you go in terms of expiry. So um, it's less risk the further out you go. However, they don't move as much. So like I said, it really depends on what strategy you're going for and how much time you want to give the stock to achieve this price that you're going for. So this is where my strategy is kind of pinpointed on which contracts I use and and so on. Um, so basically, I really love to trade key levels, um, and I'll try to give a couple examples on that. Um, for example, the amount of times the SPY touched this level and reacted to it is where a lot of money can be made, as well as up here. Even though you didn't swing trade the whole move down, just this rejection, the sell the next day could have been like hundreds of percents if you were trading high risk options. Um, so the goal isn't to catch the home run, like the whole move down. It's really just to catch a little move, even off this, like it's eight of the 445 back to 446. Just that $1 move can be like a 30% gain in what we call lotto options. Lottos are the same week expiry options. SPY has options expiring Monday, Wednesday, and Friday every week unless there's holidays. So those are the closer you are to your expiry, the higher risk it can be. So basically, what I look for is some key levels that I want to trade off of, and trade the highest volatile times of the day off those levels. So I prefer to trade the very early morning, so like the first 30 minutes, as well as the end of day, especially because that's when the highest volume comes in, and the biggest moves come in as well. And especially when stocks gap up or down, things get very volatile very fast, and you can quickly profit off some key levels and um, plans that you have. So there are certain times of day that are more probable than others. Like I said, I really love trading the mornings. Basically, you see your gap coming, and you trade the retest or the test of your level, and it's as simple as that. So um, let's see. So on most days, like really like most days that I want to enter a trade, my levels need to be predefined. So I'm not gonna just wait for any type of top and just jump in at any moment. I really want to have a plan before the market opens and wait for exactly what I want to see and take my risk at my exact level. Or else you're kind of winging it, and especially when you wing it, emotions come into play, and that's really the opposite of what you want in trading. Your emotions will sway you the wrong way, and basically you just need to stick to your plan, what you think the price will do once it hits that level, and always take profit very quickly um, as it's in front of you in options, especially in the higher risk expiries. You really want to take profits very quickly and take what you can get as soon as you can. Scale out, and if you really want to, you could leave some runners, like a few contracts left to run and see what they can do, basically. But that's after you've taken profit and taken your money back and locked in some gain. Um, so if you look at Pfizer, for example, this is it's a very clean stock to trade because it has a lot of clearly defined candles. When I look for scalps, I look for small candles like dojis and hammers. Um, those are really the ones that catch my eye, as well as inside days. So basically, when the candle you're looking at here is inside the previous day's candle, that's when you want to look for a trade on the break of either the bottom or the top of the previous candle. So I'm gonna go into a couple setups that I look for. Um, it's kind of so basically it really depends on the chart setup, and not every chart is the same, even though it may appear the same. So I'm gonna go over a few different types of trades I would look for and execute, and we'll go over the like a bunch more in the room in real time, um, and really play this out. But for example, looking at these trades here, um, here's a big gap down that hit support and bounced. We don't really we could trade this level based off like the support it has. So let's say during the day you see a dip down to this key level, you could just buy the level and sell the rip instantly. That's one way of doing it. You have your levels predefined. Here you could buy calls on any single one of these touches and make money on the bounce, basically, because we're looking to sell the same day most of the time. So you're not really worried about what it does after the bounce. Like here, here you could have made money this day off the 42.50 and sold at 52.50 and sold instantly here, and the next day it could have tanked and you would have still made your money. So here's one, the main way of doing this is just having your big levels predefined on your chart, and once you see them hit, you see you see it run down into that level, that's when you take it. So here it dips down into it, instantly popped. Dips down into it again, double bottom, instantly pop. Here again, another dip in the morning, pop again. So in a situation like this, you just take the level as it's rushing into it, because um, in options you really want to trade the impulse move, because the premium of the option is really spiking at that point. So because of the time decay, there's an effect with the premium that really spikes the price of the contract. So the algorithms are, let's say, selling it big time, and this is when you can get in at a really cheap price, because the algorithms are creating that premium for you. And same goes for on the spikes. As it's spiking really hard, it's the premium is going to go up really fast, and if it trades sideways, the premium will slowly decay because of the time factor. So, and when it comes to levels, you want to trade, you want to find your entry as soon as it hits your level. So like around here, you just you have your contract ready. As long as it has a tight spread, you market buy. You have your market order ready. You're watching the chart at the same time, and you market buy as soon as it hits your level. As soon as it pops back up, you take partial profits. Unless you really have a clear target, like it's say up here, then you could keep some, but always take some. I usually sell in thirds or quarters or halves at a time. Sometimes even if I'm really just trading the level, even though let's say I'm bearish on Pfizer and it's hitting my level, um, I'll take the trade just for the quick bounce and sell it all instantly, just for like whatever I can get basically off the first level. So here I have this level here as my support, and I'll look for anything like even up here. If you sell it like 40 cents higher, you will make a profit. Especially when it happens that fast, you will make a profit. So it really depends what you're looking for. Um, but you really got to take the level as it comes, and if you miss the level, move on to the next trade or the next chart. So that's one way of trading scalping options. You basically have your levels. As soon as it hits, you take your entry and you base your targets off the previous highs. So again, moving to this again, going back into it. Um, let's say here you have uh, a big dip from 53.30 into 52.40. So the most recent high is up here at 53.30 again. So that's usually a clear target for me, as well as let's say this confluence over here, 52.75. So if I'm taking this level, I would probably sell some as soon as I hit this confluence, so 52.80-ish, and then look for the most recent high of 53.20 and probably take the rest off there. So this all here is confluence as well. Um, Usually just take the quick gain, and especially if you're trading lottos, which is the same week expiry, you can make 30 to 50% in a tiny move, like less than $1, like a 1% move on Pfizer, and you can make your 30-40% very quickly. Um, and the further you are into the week, let's say it's on a Friday, it expires that day, those will be extremely volatile. So that's one uh, strategy on trading levels. The next one I'm going to go into is trading inside days. So here's where you look for key candles, for example, dojis and inside days of previous candles. So um, Pfizer for some reason has so many dojis lately, and it's been really a clean trader because of it. Um, so here, for example, you got 3 inside days. It closed. It did wick above, but however, it closed inside the same range as before. So you would basically mark this level, this 49.80 level, as your key level. And if it would open this day above it, you would go long into that level. And if it would open below it, you would basically short at that level. So after multiple inside days, it's bound to come up with a breaking candle, breaking the insides of the previous candles. So this is one example of how you could use this level to play the downside. Another uh, another one I played here was the big doji after. So here from this leg down, I didn't trade any of these. However, once it took a big dip from 49.60 to 45.60-ish. So it's almost it's like an 8% move, and all these the Nasdaq stocks, they always bounce back if they're oversold basically, and so that's one thing to keep in mind. So after a big retracement like that, you see a big doji, and it was also green with some volume as well. So you look at that, and you see, okay, so there was some indecision on this day. Even after dumping under the 200 MA, there was some indecision by the bears and the bulls, and the next candle is going to be very like decisive on where they want the price to go. So you mark this level, the 45.80, and the open and the close of it as well, and you basically trade off that. So if it breaks your 46, you go long, and if it breaks under the 45.80, you could have shorted. So you're basically just playing the small candle and playing the break of it, or the close, the support levels at the close of the candle. Here's another example of inside days. So here you have a big bullish candle after a nice breakout. It's looking very strong, especially with the volume on this candle. The next day, a big hammer uh, holding the 50 MA and staying inside the previous candle, so it's basically holding all of its gains. And then the candle after that as well closed inside the bodies of these two candles. So this is a very bullish sign, and basically a good candidate for this day here, which is today, for going long. All you need to do is mark your level here, 52.95, and once that breaks, you buy calls with a stop, either uh, this is the next part of the explanation. So you buy calls at the 52.90, 95. You buy on the breakout. You look for the most recent lows as your stop loss level. So here, a very clear one and strong stop loss would be the 52.43, because that's what the hourly held before the breakout. So I usually look for that, and once you're in the profit zone, you raise your stop loss to your entry. So this was the key level you used, 52.95. So you use that as your stop loss as well. And breaking under that would basically invalidate your thesis of the breakout above that level. So if it breaks back below, that's where you would stop out of the contract. So unfortunately, there's no way to place stop losses on the contract based on stock prices. So what I do always is have the two tabs open. I have my options contract position open, and I have my chart open as well. And once I see the level breaking below or above, that's when I'll stop out of the contract using a market order if possible. If not, I'll use a limit order with a tight limit, basically ensuring that I don't fill too far away from the current price of the contract if there's a spread on the contract. So that's pretty much how I trade inside days, levels, and small body candles as well. Um, like I said, like all of these candles, once you see some big confluence like that, you get ready for the big break. Like here, it was it it opened above this level, and it turned out to be a trap. So you see this as like an indicator that there could be some resistance here. After that day, you see that there was some indecision after breaking new all-time highs. So like this day, it opened below the previous close, retested the previous close or big level from all these candles, and then just tanked right after. So I'm not saying you could have nailed the top and you could have made the 100,000% by knowing this was the bottom. That's not what I'm saying at all. I'm just saying you could have used this candle to make big money on this big leg down and rejection. So it's pretty much what we're looking for. Clear levels you could risk off to make quick money on the move that's gonna follow. Um, Facebook, for example, just this week we went long at 190, 191. I bought at 191-ish. basically I was going for the inside break upward. So you see here just this body here making a new 52-week low, or retesting the 52-week low at 187. Then you have an inverted hammer, which is like a inverted hanging man also. It's a very strong candle. And then the day after, we see a huge hammer off that level. So where it closed is where we found huge support, and we developed a big bullish hammer here. And that's what convinced me that we were going to break this inside candle. So I took a position here um, before the actual break. Actually, I took a starter before, and while it was breaking the 192 end of day, that's when I added to my position. And we ended up gapping up and going. So if I wasn't in this position on this day and I didn't get the retest of this candle 192, I probably wouldn't have bought it. But because I was in here with strong conviction, especially from one of the guys in the chat, Vince, um, I trusted my instincts, and I assumed it was going to break this level here. And if I was in, I ended up taking this as a long, but it's also a good uh, a good candidate for a scalp as well. But the thing is, especially in this market, I would rather not hold overnight, so I probably wouldn't have held it overnight. So I'm just showing how inside days can be used. Um, uh, let's see. There's many ways you can trade a lot of these stocks. For example, AMD for tomorrow. Let's say we're looking for a trade for tomorrow. Let's say I just move this out for now. I like how this candle today was inside the previous candle. Even though it was leaning downward, like basically not below the median of this candle, it's still inside the candle and holding the support quite well. So I would mark this level here. Yesterday's open has my support level. So the 111.70, that'll be the support. So hold on. So, and you can adjust this to around here as well, or use this. So basically tomorrow, if we would get a gap above the close, so anything above 1160 or 70, let's say around here, you would look for a dip into your level, so 112-ish, 111.70, and buy calls at that point, targeting let's say 114, 115. That's one way of playing the quick morning gap up. So let's say if it's a small gap up, you buy the dip, sell the instant push around here at resistance. Or you can also wait for the candle to develop and see if it wants to break the previous highs of 115, and then buy the calls, risking off this level. So let's say you're buying the breakout, you put your stop loss right under it, and use that as your risk level. If it were to gap downward, you would want to buy from these bottom wicks. Both times it held support at 109.70. So that would be a good dip buy if it were to dip into that level in the morning. You buy here, sell the close instantly. It would be like close to $2 move, a 2% move almost. So options expiring tomorrow could easily move 50% on a type of move like that. So the higher risk options you go for, the less money you, the less money you need to, the less capital you need to risk. So you could use less money than a further dated options contract. However, you'll get a bigger percent gain or loss. So it's good for growing small accounts, trading high risk options, and it's good for making your quick money off a small move on the actual stock. Um, Another type of trading that I like to use is orb trading. So I'm not an expert on orbs. I'm kind of just getting used to it ever since I started scalping options. However, it's proven very effective in big gap ups or big gap downs, and it's a great way to scalp the mornings. For example, let's look for one here. I generally like to use the 5 minute orb. Um, so here, let's say closed at 109.50 AMD, and then the next day it opened on a gap up at it opened at 1160. So an orb is basically an opening range breakout. So when you break out into a new range, it doesn't need to be a gap up, but gap ups are basically an orb. So you see it moving into a new range. It's basically breaking out of the previous range, and you basically want to see what it's going to do after that break. So the rule of thumb I use and many traders use is wait for 3 candles on either I usually use the 5 minute, but you can use it on any time frame that suits you. So you can use it on the 15, the 5 minute, the hourly. The orb is basically reading the breakout and where the next candle is going to be. So in the mornings, the very volatile parts of the morning, orbs are very useful to see where the volatility is going to lead. So let's say you let this candle play out, you take no position. You let the second candle play out, you take no position. You could wait for, let's say, a breakdown of this level, then 111, or you could have also played the rejection here at 112.25 if it popped into that level and you already had this candle. However, the rule of thumb is wait for the third candle. Here on the third candle, it opened down here at this candle at the support of this one as well, 111, and then instantly popped. Where you would take the trade is on the break of this high, these highs. So you have 2 candles as confirmation, you have 2 candles here as support, 2 candles of resistance. You play the break of that, and it's a really quick selling strategy. You really just scale out as soon as you see profit. So here you're you play the break here at 112.25. That's your entry, and your stop loss would be at the most recent support, so 112, 112-ish, 112.10. And as soon as you get into the profit zone, you try to raise your stop back to your entry price. So here it ended up retesting. You could also play the retest of the orb if you wished, but the if you're expecting a volatile move, you could play the break of the 3 candles here basically. So and as well as for taking profit, you scale out as soon as you see profit. Basically, you see profit, take profit. But if you have your predefined level, you could wait and see if that level could be achieved and keep some of your position left to achieve that level, basically. Let's see Facebook yesterday on the gap up. So after we bought that, assuming it was going to break the inside day upward. So Facebook, going back to the chart here, after we bought this close, it gapped up and had an orb here. So sometimes the orb plays out better on different time frames. So sometimes it works best on the 5, sometimes it works best on the 15 or the hourly, but the same rule applies. So here you have a big candle up, rejection. Here again, a big doji inside this candle, so an inside candle. Then you see the third candle testing upward. You could have bought this break, but you still have this resistance here, so it's a bit of a tricky one. Then the next candle retests the levels of these candles, so it held again. And then where I would buy would be on the fifth candle in this case. So this candle, this candle here proved to hold support again, and this candle here proved it again and again. And then once it made the higher high, that's when I'll take my entry. So I'll take the entry around here, 196.50 or 196.80, and put my stop loss around this doji level here, which proved to hold on the candles that I'm buying. So 196 basically would be my stop loss, and instantly take profit as soon as I see it. 197.50, I would take some profit. It held the higher low, so I stay in my position. I sell the next impulse, and so on and so forth. You could keep raising your stop loss. You could also play it if you wished. If you're really convinced that this level was going to hold as support, and you want to see as much, like you want to see what it can do, you could keep raising your stop loss. Basically, some traders prefer to trade orbs that way, or trade anything in that way. So let's say this is your level you're risking off at first. It breaks up. It develops new support. Okay, so like let me use this then. So you have your one. You're not now you raise your stop loss to 196.75, ensuring that your profit, ensuring that you stay in the profit essentially. Then once this held, you uh, you see a breakout higher. You wait for the next low, or you could even, as soon as you see the breakout, you could immediately raise it over this level, and then after the new low, you would raise it to the new low, and essentially keep raising it until here you would get stopped out. Still capturing more than a $3 move, which is great. And as you can see, it ended up rejecting the level and making it all the way back to our previous entry. So this would be a great stop out. But personally, if you're not convinced on how strong you expect the move to be, I always sell the impulse moves up, because the premiums of the contract really are affected greatly when you see some big and fast moves. Um, so that's basically the gist of it, on how I trade options. And like I said, we're gonna be going over a lot of trades in the green room. Um, Here's another good example for tomorrow, what I would like to see. Bank of America, you have your resistance level here, and your support over here, and your 200-day is right there as well. So here you have a big candle breaking out of this range, and then the next candle is an inside day. So today was an inside day. It held the same support as yesterday, 42 bucks, and closed at the same resistance as yesterday, 43 bucks. So tomorrow's candle, let's say it broke over 43 bucks, that's when you go long. I would instantly sell some at the 200-day MA, because that's where the selling algorithms will come in on the first touch for sure. And then if it can break higher, I'll keep some runners and see if I can get the next level, which I would assume to be $45 near the 50 MA as well. So this is a good inside day setup as well. As you can see here, there's 3 inside days to break out above. You could have played any one of these candles. If you were playing the inside here, I would just buy the support of the previous candle and this candle here. So yeah, just reviewing what I just explained. But one last thing to say is, if you're expecting extreme volatility and you're trading a high risk options expiry, so basically like let's say it's a Friday and it expires that day, you really want to tone down your size and play with smaller capital, because the percentage gain will be much greater than a further out expiry. The other way to do it, to risk less of a loss if you are in the wrong, is by trading a further out expiry. So instead of basically trading the, say, 440, say you thought it was going to go over 441 today and you were wrong. So it went from 435, or let's use the 442 for example, or the 443. You expected it to go over 443 today, and SPY did a $6 move or $5 move, and your contract still went red. That's because your contract expires tomorrow, and if it's not above 443, it's going to be at zero. However, if you bought, let's say, an April call of 442 or 443, 444, sorry. For some reason, it's not showing the 443 here. You would have made, this might be a glitch. It seems to be a glitch. Using Weevil, so it's not 100% accurate. But if you were to go out for a further date and SPY did that $6 move, and you're not in the money yet, but you have plenty of time to be in the money, that's where you'll still see a gain, even though your strike price wasn't achieved yet. So that's one way of limiting your risk as well. So the closer the expiry, the less capital you should be putting in, and the further the expiry, the more capital you should be putting in. So it all depends on how fast you'll think you'll get your move in options. But like I said, when we're scalping options, just trading off the levels and off the breaks. I like to trade high risk options, basically lottos expiring this week, and because they're so volatile, that's why you need to take profit as soon as you see it, and don't get greedy. Um, it's hard to keep the emotions out of it sometimes, but you really got to be a robot about it and take the level. Sell as soon as you see profit, just take it and get really mechanical in this system and get in a habit of trading this way all the time. Um, like I said, there's swing trading and there's scalp trading. This is scalp trading strictly, so it's not the time to get greedy and expect a huge move just because the shorts could get squeezed or the longs could get squeezed. You really gotta just take what you have in front of you and take what the market can give you, because the market doesn't care what you want, and it's just gonna play out as uh, with the path of least resistance. So that's pretty much it. If there's any questions, you can put it in the comment section or DM me. Um, like I said, we're going to be trading a few of these in the green room, so some participation would be appreciated. And good luck to everyone who's trying this out from the beginning, from the start. It can be very profitable if you use it the right way, and it could be very detrimental if you use it the wrong way. So be humbled by it. Options is a very complex game, and I know a lot of people have blown up accounts as well in options, but the most successful traders trade options consistently for profit, and it's an amazing tool if you know how to use them properly. So if you're getting into it, good luck, and I hope this video helped you familiarize with the strategy and options in general. So yeah, thank you guys for listening, and see you soon. Bye.